Hey, what is going on, guys? So earlier this year, I made a Corp Dev video here that was pretty well received, that goes into sort of the salary, the expectations. Later on, I followed up that video with one here, which paints sort of a different lens as far as giving you a balanced perspective as why Corp Dev might not be for you. Now, if you've watched both sides and still decide that you wanted to go for it, then this video is for you, which answers the question, how do I actually get a job in this field? In particular, I wanted to shed some light on the case interview process, which is probably the biggest unknown for most applicants. Unlike investment banking or private equity, your interviews can be a little bit more random, but as someone who's been on both sides of the playing field, both as an interviewee as well as recruiter for these types of roles, I'm going to be breaking down the types of case interviews I see most often. I'll be sharing some actual examples that I used as an applicant, as well as some sample responses that would have scored well according to an internal rubric that I had across a couple of the firms that I was personally an interviewer for. For those of you who are new to the channel, welcome. I go by Tenbagger. I'm a 27-year-old self-made millionaire investor, and I turned to YouTube to share some stock ideas and career advice that worked for me and hopefully will work for you. All right, before we touch on the actual case interview itself, I'm going to spend just a quick minute on the story and the behavioral section, and it really comes down to this. Corp Dev is essentially a finance job. When you talk about your deals, when you talk about your story, you'll want to know all the details because your interviewer will snuff them out. No, this is not meant to scare you, but you have to remember that the guys who are interviewing you are ex-bankers and ex-PE guys, especially at the big tech companies. So if you go into these interviews thinking that it's going to be banking-like or PE-like process, you're probably going to be disappointed. After all, a lot of these guys could have worked in other areas of finance, but they chose not to for lifestyle reasons. You also want to have some pretty good reasons as far as why you want to do Corp Dev. Specifically, if you watch this video, you should have some pretty good answers. But to summarize, I think the two reasons that generally work really well, especially if you're coming from banking, are wanting to get much deeper investing experience or a hybrid of investing and operating experience, or wanting to develop much deeper industry relationships and industry experience. The hours obviously are better, but everybody knows that. That's probably not something that I would necessarily lead with. All right then, that intro aside, let's get to the dreaded case study. The thing you want to remember about the case study is just like there are a million variants of corporate development roles, your case study can vary a ton from firm to firm as well, as each firm looks for different types of things depending on the stage of the company, depending on the industry, depending on lots of factors. But have no fear, because I'm going to be going over two variants, a more intense version that looks at a formal presentation plus an investment case for a particular company in the software vertical, as well as a less intense version that's looking to test your knowledge of a certain vertical or certain financial statements. Typically, you only see one of the two, but I have seen instances where they ask you to do a detailed pitch and then come in person for a modeling test to make sure that you actually did it. As a special treat, I'm actually going to walk you through exactly what I did in my Etsy case, which led me to get an offer. Now, I can't actually share the slides because that would breach confidentiality, but I can at least give you a sense of what they're expecting, my thought process, and what you might be looking to do for your own. So back in 2016, Etsy was trading like garbage. Like, we're talking $10 a share back in 2016. And that was following some pretty disastrous earnings results. Amazon Handmade had just launched, which put some competitive pressure on the stock. That might not be a great sign, but it actually is, in a weird way, a powerful signal for buy-side investors such as corporates and private equity guys. These types of investors love buying properties on the cheap and then turning them around. At the time I did the case, though, I did see signs of the ship righting itself. The first is with the appointment of Josh Silverman, a former eBay executive who took over as CEO and shuffled ranks. The second, and most importantly, the company decided to raise its take rates for the first time in 13 years. Guys, you have no idea how ridiculously low a take rate of 3.9% is. I mean, you can't even cover your credit card processing fees of 2.9%, let alone make a profit. Pretty much every single marketplace out there will charge at least 10%, upwards of 30% in some cases. And when you consider that a lot of these sellers don't necessarily have loyalty to Etsy, they're cross-selling other platforms like eBay and Poshmark, it really makes no sense to charge such a low take rate. So that's a huge sign of improvement. My thesis was that this was a no-brainer way to increase revenue without necessarily incurring that much customer attrition. I too like Josh Silverman's strategy of positioning Etsy as a portal to buy anything that's unique or not mass-produced or drop-shipped from China. So instead of pivoting, as the company usually did heavily around the holidays such as Mother's Day and Valentine's Day, Etsy could be the one-stop portal for anything that's one of a kind or made with love. I know it sounds a little bit cheesy, but being the anti-Amazon actually carries a pretty substantial TAM. Then I moved on to valuation, and this is where things can get a little bit tricky, especially for internet companies. See, usually the end goal for valuation within a corporate development lens is going to be your accretion dilution. But too often what I see is applicants tell me, okay, well, this company is going to be dilutive, so maybe we can layer on some pretty aggressive synergies, but it's going to be a pretty high bar to clear, so therefore we shouldn't do that deal. I mean, maybe I'm a little bit biased because my background is in tech, but good luck finding attractive properties out there that also happen to trade on the cheap. And while you're at it, maybe consider sending your resume to industrials, oil and gas companies, or paper and packaging places for your Corp Dev exit, where I'm sure you'll fit right in. The point is, guys, there's many ways to justify a deal besides price alone. The first is you probably want to look at what other companies the parent had acquired. Maybe some of these are trading at multiples beyond the company that you're looking at. And companies love it when you do this because it shows that you've taken an interest into understanding the company, its history, and what makes them tick. So use that shit to your advantage. The second is maybe it's highly strategic. Maybe it fulfills a niche that the company has been trying to get more entrenched in for a long time. For instance, Goldman has been trying to get into the consumer business or become a more dominant force in consumer banking for the past many years, many quarters. So if there was a consumer company that checked all the other boxes except for price, they might be more inclined to pay a higher multiple for that. Now, the third is you can make it slightly conditional in terms of what the company's policy with respect to whether they care about GAAP versus non-GAAP EPS or whether they require a certain period to pay back the acquisition. Oftentimes, a company will only look at the impact to adjusted or non-GAAP EPS, or they'll forgive an acquisition for being dilutive in the first 2 years if eventually, but let's say by the third year, it reaches EPS accretion. Now, this isn't cheating. I know sometimes companies want you to give them a straight answer, should you buy it or should you not? But as long as the rest of your investment thesis isn't wishy-washy, after all, you have no idea what the company's internal policies with respect to something like this is, so it doesn't hurt to ask. So overall, I gave a yes recommendation based on the things I mentioned above, but I also mentioned some other things for extra credit. First is I noted that the parent company had a considerable amount of debt on its balance sheet. So doing any sort of large acquisition at this time would expose the company to additional debt and would necessitate either share sales or additional debt on its balance sheet. The second is the company had just done a couple acquisitions, which might have contributed to that debt in the first place. So potentially the appetite for future M&A at this point would have been pretty low. It might make sense to wait a couple quarters. And the third point, which borrows from the first two, is that Etsy had just undergone a fundamental change with respect to its pricing. And although my expectation is that both sides of the marketplace can absorb this, it might make sense, especially in light of some of the issues that the company is facing, to delay the acquisition by a couple quarters, then assess with certainty what the impact is on different cohorts and on different users. So hopefully that gives you a sense or flavor of how you can use the company's unique characteristics to justify invest or non-invest recommendation for a particular deal. All right, now that we've talked about the more intense process, I want to also share what a less intense test might look like, which tests your knowledge of financial statements and company valuation. One process for a big tech company literally just had me project out the income statement for 5 years, get down to free cash flow, build a DCF, figure out what some good comps would be for that company, and put together a football field. That was it. Now, that might seem simple on the surface, but what they're really testing, besides whether you can walk from net income to free cash flow, is your knowledge of the industry, of software, of your ability to create and defend your assumptions. For instance, for a particular SaaS company that I had to project out, you want to figure out what the end user is going to be, because those are what the seats are going to be sold to. You also want to look at the license terms. For instance, this company had 1 year and 3 year licenses, as well as geographic distribution, which in the case of this study was 50-50 US versus international. All of these different characteristics and nuances should play a role in terms of how you should bottoms up build your revenue. For instance, 3 year licenses should on average churn less than your 1 year licenses, and US based customers should have a higher price point than your international customers based on their ability to pay. Especially with a case like this, where there aren't that many moving parts, I almost guarantee you that your interviewer will spend a lot of time pressure testing your assumptions. So it does make a lot of sense to spend some TLC here. When you get down to the expense section, pay special attention to the sales and marketing spend. If your revenue is going like this, then your sales and marketing spend should, generally speaking, increase by a significant amount as well. But also pay attention to make sure that it doesn't exceed your revenue growth, because that's usually a negative sign and not necessarily industry standard. But yeah, guys, otherwise, I think the rest of the case is generally pretty straightforward, especially if you came from a banking background, getting from net income to free cash flow, building the DCF, finding good comps for both your precedents and your transaction multiples. These are things that you generally do in your sleep by now, right? Now, I want to give a final word of caution. Usually the way these case studies are structured is that they give you a certain amount of time to do it. You might have 24, 48, 72 hours, or up to a week to complete. But note that in almost all instances, they ask you not to spend more than a certain number of hours on it. It might be 3, it might be 4, it might be as many as 6. But please do try to stick to that time frame. I can't tell you how many times when I've interviewed candidates, and keep in mind, we track all the responses. And after we interview like 20, 25 candidates and we receive all their case studies, it's really obvious when a tryhard goes way above and beyond and, obliterates that time limit, right? And we don't take kindly to that kind of call it cheating. So please do your best to stay within the confines of the time that's being allotted, because that can potentially work against you. Anyway, guys, I hope that was helpful. Like I said, there's so many different variations of Corp Dev jobs out there, which results in a dizzying array of case studies. And while I cover 2 of the most common ones that I've seen and I've personally done in my recruiting process, it's just not really feasible to cover all of them for this video. Having said that though, if you have questions specific to your circumstance, drop a comment down below and I'll get back to you. All right, guys, thanks so much. As always, nothing is more valuable than your time, except for maybe your money. And with that, I hope to catch you on the next one. Peace out.